The global economy continues to display remarkable resilience, with inflation declining steadily and growth holding up. The chance of a soft landing has increased, but the pace of expansion remains slow and risks remain. On the demand side, global activity was supported by stronger private and government spending, despite tight monetary conditions. On the supply side, increased labor force participation, mended supply chains, and cheaper energy and commodity prices helped, despite renewed geopolitical uncertainties. Global growth under our baseline forecast will be steady at 3.1% this year, a 0.2 percentage point upgrade from our October projections, before edging up to 3.2% next year. Important divergences remain. We expect slower growth in the United States, where tight monetary policy is still working through the economy, and in China, where weaker consumption and investment continue to weigh on activity. In the euro area, activity is expected to rebound slightly after a challenging 2023, when high energy prices and tight monetary policy restricted demand. Many other economies continue to show great resilience, with growth accelerating in Brazil, India, and Southeast Asia's major economies. In sub-Saharan Africa, growth is projected to rise as the negative effects of earlier weather shocks subside and supply issues gradually improve. Inflation continues to ease. Excluding Argentina, global headline inflation will decline to 4.9% this year, down 0.4 percentage points from our October projection. For advanced economies, inflation will average around 2.6% this year, close to central bank targets. With the improved outlook, risks are now broadly balanced. On the upside, disinflation could happen faster than anticipated, allowing central banks to ease sooner. Announced fiscal consolidation measures may be delayed in what is the biggest global election year in history. This could boost economic activity, but also spur inflation and increase the prospect of disruption later. On the downside, renewed geopolitical tensions, especially in the Middle East, with increased attacks on ships in the Red Sea, could disrupt commodity and supply chains. Core inflation could also remain high as services inflation proves more persistent, and wage developments could also add to price pressures. Finally, financial conditions could tighten, raising long-term interest rates and putting renewed pressures on economies and governments. A substantial share of the recent disinflation occurred via a decline in commodity and energy prices, rather than through the contraction of economic activity brought by tight monetary policy. But monetary tightening worked through two additional channels. First, the rapid pace of tightening convinced people and companies that high inflation would not be allowed to take hold. This prevented inflation expectations from persistently rising and reduced the risk of a wage price spiral. Second, the unusually synchronized nature of tightening lowered world energy demand and prices, directly reducing headline inflation. Central banks must now avoid a premature easing that would undo hard-earned credibility and lead to a rebound in inflation. But they must also avoid waiting too long, as signs of strains are growing in interest rate-sensitive sectors such as construction, and loan activity has declined markedly in many countries. Staying on the path toward a soft landing will not be easy. The biggest challenge ahead of us is to tackle elevated fiscal risks. Most countries came out of the pandemic and energy crisis with higher public debt levels and higher borrowing costs. Bringing down public debt and deficits will help deal with future shocks. First, fiscal measures introduced to offset high energy prices should be phased out right away, as the energy crisis is behind us. But more is needed. The most pressing risk is that countries do too little, too late. In that case, fiscal fragilities will build up until the risk of a fiscal crisis forces sudden and disruptive adjustments at great cost. In some countries, there is also a risk of doing too much, too soon, and this could jeopardize growth prospects. It would also make it much harder to address imminent fiscal challenges, such as the climate transition. What is needed is to implement a steady fiscal consolidation with a non-trivial first installment combined with an improved and well-enforced fiscal framework. So future consolidation efforts are both sizable and credible. The opportunity should not be wasted. Emerging markets have been very resilient with stronger than expected growth and stable external balances, partly due to improved monetary and fiscal frameworks. Yet divergence in policy between countries may spur capital outflows and currency volatility. This calls for stronger buffers in line with our integrated policy framework. The pressure on borrowing costs is particularly acute for low-income and developing countries, many of which are in Africa. They are being increasingly priced out of the market. This is crowding out necessary investments and hampering their recovery. These countries need to mobilize revenues, improve their policy framework, and if they are at high risk of debt distress, work on orderly debt restructuring. The IMF is also providing crucial financial assistance, allowing these countries to protect the most vulnerable while maintaining economic and financial stability. This includes the temporary food shock window and the resilience and sustainability facility. Beyond fiscal consolidation, the focus should return to medium-term growth. We project global growth at 3.2% next year, which is still well below historical average. Our research shows that reforms that ease the most binding constraints to economic activity, such as governance, business regulation, and external sector reform, can help unleash latent productivity gains. Stronger growth could also come from limiting geo-economic fragmentation by, for instance, removing the trade barriers that are impeding trade flows between different geopolitical blocs, including in low-carbon technology products that are crucially needed by emerging and developing countries for the climate transition. Instead, we should strive to keep our economies more interconnected. Only by doing so can we work together on shared priorities. Multilateral cooperation remains the best approach to address global challenges. Progress toward that goal, such as the recent 50% increase of the fund's permanent resources, is welcome. Finally, the creation of a 25th chair of the IMF Executive Board for Sub-Saharan Africa, the entry of the African Union as a permanent member of the Group of 20, and South Africa's presidency of the G20 in 2025 highlight the growing importance that the region and South Africa will play in the global economy in the 21st century.